If you were producing silver at $20 and selling it at $40, that's a $20 margin. Now, if silver's price doubles, your profits don't just double, they quadruple. That's the key. And right now, the valuations of silver mining stocks are still discounting much lower silver prices. If today ES silver price holds, and there is strong reason to think it can, the net present values assigned to these producers are way too low. Silver has surged from around $65 at the end of 2025 to $113 per ounce. With recent highs near $117, that's roughly a 74% increase, a solid move. But for primary silver producers with all-in sustaining costs, AISC, around $16-20 per ounce, profits didn't rise 74%. They exploded about 100%, from roughly $45, $47 per ounce to $93 to $97. Same trucks, same diesel, same workers, same permits. Double the profit without any increase in operational costs. Yet silver mining stocks are up only 50 to 100% in recent months. Wall Street is still pricing these companies as if silver is $90, $100, some models even lower, treating this rally as temporary. Analysts haven't fully updated their forecasts. They're waiting for proof the rally is sustainable. That hesitation is your window, a rare opportunity where profits are being printed in real time while markets lag behind. Let's break down the mechanics. AISC includes labor, diesel, equipment maintenance, royalties, permits, overhead, and sustaining capital. For most primary silver producers, that's $16-20 per ounce. These costs are largely fixed. Mines donning T hire double the workforce because silver hits 113. Trucks donning T burn twice as much diesel. The processing plants don't use more electricity. Every dollar silver rises above that threshold flows straight to profit. Think of it like a hot dog stand. Each hot dog costs $2, you sell for $4, profit $2. If demand spikes and you sell for $8, your profit isn't just doubled, it jumps to $6, a 200% profit surge. That's operating leverage in action. Now apply it to silver miners. $65 per ounce, $45.40 silver profit, jump to $113, profit becomes $93, $97. Same operation, same fixed costs, huge margin expansion. Rick Rule has seen this movie before, with gold in 2005, uranium in 2007. Fixed costs plus rising commodity prices equals exponential earnings growth. And now it's happening with silver. But here's where it gets fascinating. Despite silver climbing from 65 to 113, mining stocks have rallied 50, 100%. Valuations still imply silver closer to $90, $100. Earnings estimates for Q1 2026 are catching up from older models. Institutional money hasn't fully rotated in. Fund managers remain skeptical, burned by past spikes in 2011 and 2020. They re-waiting for confirmation. Multiple quarters of elevated earnings, proof industrial demand isn't just a one-quarter blip, and that hesitation is the opportunity. Q4 earnings in February and March will show doubled profits per ounce for producers like First Majestic and Heckler. Once analysts update forecasts, stocks will reprice. And by then, the market may have already moved. A deeper point, operating leverage works both ways. If silver drops from $113 back to $90, profit margins collapse just as fast. Miners are leveraged plays, volatility is inherent. Which brings us to the key question, is $130 silver sustainable or another speculative spike? If you think we're back to $90 by spring, chasing mining stocks now is the wrong move. You'd be buying leverage into a falling asset. But if you believe structural factors are durable, industrial demand from solar, EVs, AI, defense, central bank gold buying spilling into silver, geopolitical fragmentation, and BRICS diversification, then current stock gains are still early. Supply-side constraints reinforce this. Primary mine supply has been flat since 2018. New deposits take 5-7 years to come online. Environmental opposition is rising. Meanwhile, solar installations globally are projected to grow 40% YOY through 2028, with each GW requiring roughly 30 tons of silver. EVs, 5G, military electronics, demand is accelerating faster than supply. China, producing carbon 15% of global mined silver, has implemented export controls on certain refined metals under national security mandates. Licensing and strategic reserve accumulation are already shifting the global supply balance. If Beijing treats silver as strategically critical, Western miners may become the only unrestricted source for US and European industrial consumers. This is documented policy, not speculation. That's why Rick Rule is grinning. Fixed costs, rising prices, structural deficits, geopolitical supply constraints, and a market that hasn't fully priced it yet, all the pieces are aligned. Operating leverage is just the surface. The structural supply-demand imbalance is the foundation. Of course, this isn't a one-sided trade. There are risks. technical resistance, profit taking, and volatility. Silver is testing a multi-year resistance zone around $100, $110, with recent highs near $117. If it fails to break and hold above this zone, prices could retreat back toward the 90s. And if silver corrects 15%, mining stocks with operating leverage could easily drop 30-40%. That's the flip side. Leverage works both ways. Second, macro headwinds. If the Federal Reserve pivots more hawkishly than expected, if real yields spike because inflation remains stickier than anticipated, or if the dollar rallies sharply on safe haven flows during geopolitical escalations, precious metals historically struggle. Gold and silver thrive when real rates are negative or near zero. When 10-year TIPS yields push above 2%, the opportunity cost of holding non-yielding assets rises, and that's a risk. Third, mine production could surprise on the upside. High silver prices could bring marginal deposits back online that were uneconomical before, adding incremental supply by late 2026 or early 2027. It won't erase the deficit, but it could slow the pace of inventory drawdowns, easing some of the physical tightness that's supporting prices today. Fourth, equity-specific risks. Even if silver stays elevated, companies can fail in execution. Cost overruns, permitting delays, labor strikes, environmental incidents, or geotechnical failures. I've seen world-class deposits destroy shareholder value through mismanagement. The metal's price is only one variable. Operational competence matters. Here's the critical reframe. Every one of these risks is temporary or a delay. They don't negate the structural supply deficit. They don't halt industrial demand growth. They don't reverse central bank buying. They don't undo geopolitical fragmentation. At best, they slow the timeline. At worst, they create volatility that shakes out weak hands before the next leg higher. If you're thinking long-term of multi-year trends, these pullbacks are accumulation opportunities, not exit signals. Rick Rule didn't to build his track record by selling every time the market pulled back 10%. He did it by knowing the difference between noise and signal, between cyclical corrections and structural shifts. So where are we now? January 27th, 2026. Silver at $113 and climbing. Mining stocks up 100%, profits up around 100%. Wall Street still catching up. Structural deficits widening. Geopolitical supply risks escalating. Operating leverage doing exactly what the textbooks predict. You have three choices: ignore it entirely and stick to your current allocation. Not everyone wants exposure to volatile commodity equities, and that's rational. Wait for confirmation. Q1 earnings reports, analyst revisions, institutional money rotation, and buy after the 50-100% rally becomes a 200% plus move. More certainty, but higher entry prices. Recognize the disconnect between profit growth and stock performance. Do your due diligence on companies with strong balance sheets and low-cost operations, and position before Wall Street updates its spreadsheets. I'm not telling you which choice to make. That's your capital, risk tolerance, and timeline. But the math doesn't lie. Operating leverage is real. Fixed costs are real. Around 100% profit growth on a 74% price increase is real. Mispricings don't stay mispriced forever. If you're exploring this sector, focus here. Producers with AISC at or below $20. Verify through technical reports and MD&A filings, not just investor presentations. Strong balance sheets, manageable debt, and liquidity to weather price corrections. Mines with 10 plus years of reserves and consistent or improving grades. Avoid single asset companies where one operational hiccup could destroy the equity story. Don't chase non-producers. If a company has no production or cash flow, you're speculating, not capturing operating leverage. 3 takeaways. Operating leverage is the most underappreciated force in commodity investing. Prices rising above fixed costs accelerate profits exponentially. That's accounting, not theory. Wall Street skepticism toward precious metals rallies creates mispricings that can persist for quarters until earnings force a revaluation. By the time consensus catches up, the early gains are already made. Structural factors, supply deficits, industrial demand growth, geopolitical fragmentation aren't going away next month. This isn't a short-term trade. It's a repositioning. The unresolved tension, if operating leverage is this powerful, if the math is obvious, if generational investors are positioning here, why is Wall Street still catching up? Are they genuinely behind the curve, or do they see macro risks, recession, demand destruction, policy shifts that we're missing? No one knows for certain. That's why due diligence isn't optional. Read filings, understand assets, know the risks, size positions appropriately. This isn't T financial advice. It has a framework for thinking about a sector showing one of the widest gaps between fundamental profitability and equity valuations in years. Silver at $113 climbing. Mining stocks up 50-100%, profits soaring, structural deficits growing, operating leverage in full effect. Markets eventually catch up. The question is whether you're ready when they do.